Just think about your morning coffee mug for a second, or your phone, maybe even the shirt you're wearing. The sheer scale of global trade means at least one part, maybe the whole thing, probably traveled thousands of miles across oceans, across continents, just to get to you. I mean, we're talking trillions of dollars worth of goods moving around the world every single day. It's this sort of invisible, really intricate dance that underpins almost everything we touch. So today, we're taking a deep dive into that complex world, the world of global commerce, looking at how it's financed, how the rules get set, and, some of the hidden challenges that can pop up.
Yeah, and I think our goal here really is to go beyond just the headlines.
Yeah.
We want to pull out the really important nuggets about the systems that hold up global commerce, show what makes it incredibly efficient, but also sometimes surprisingly vulnerable. We're here to help you understand the forces shaping the global marketplace, whether you're just a consumer or maybe you're involved in a business yourself.
Right. Because at its heart, international trade is just that exchange of goods and services between countries. But its impact on the world economy? Well, it's massive.
Yeah.
And over the last few decades, we've seen truly explosive growth here. A lot of that fueled by rapid tech changes and also efforts to liberalize trade. It's completely changed how businesses work and what products you can get your hands on.
Absolutely.
So, with all that said, the big question for us today is, how does this huge exchange actually work? What are the critical, often unseen gears turning behind the scenes? When goods cross borders, the money has to follow, right? And it needs to do so safely. How do these massive payments actually happen reliably between people who might be thousands of miles apart? Maybe they've never even met.
Well, that's exactly where trade finance comes in. It's basically a collection of financial tools and processes. And they're specifically designed to mitigate risks and bridge that gap. The gap between the exporter wanting quick payment and the importer wanting to wait until they get the goods. You can sort of think of it as the low-risk, high-collateral end of the global credit economy. It's fundamental.
Low risk, high collateral. That sounds incredibly robust. Okay, so let's unpack this a bit. What are the key tools here?
Okay, absolutely. Well, one of the most common ones, really standardized, is the letter of credit. You'll hear it called an LC. This is where a bank steps in and basically makes or guarantees payment to the exporter. But, and this is crucial, only once the delivery of goods is confirmed. And that confirmation comes through proper documents. It gives a high level of security to both sides.
Right, that makes sense. Verifiable proof.
Exactly. And beyond LCs, you also see things like pre-export loans. That gives working capital to producers before they even ship. There's also factoring. That's where a business sells its invoices, its receivables, to a third party, usually at a discount, to get cash immediately. And export credits, often backed by governments, to help support international sales.
Wow, okay. So it's quite a toolkit.
It is. And this whole ecosystem, it involves a lot of players. You've got the commercial banks, obviously the importers and exporters themselves. Then there are export credit agencies offering insurance or guarantees, multilateral development banks helping out in developing economies, insurers, and of course, governments and regulators setting the framework.
And the impact of all this, trade finance, on businesses and ultimately on you listening, it seems pretty transformative. For one thing, it means much better cash flow, right?
Sure.
Like imagine a small manufacturer. They ship a big order, but payment isn't due for, say, 90 days. Factoring lets them get cash for that invoice right away, maybe minus a small percentage. So they have money to string up production run without that long wait. That's a huge deal, especially for those small and medium-sized businesses, the SMEs, who maybe don't have big cash reserves.
Absolutely. It's a lifeline for many SMEs. It lets them compete on a bigger stage. And it also opens up more opportunities for trade generally. By tackling risks like non-payment or currency swings, these tools let businesses confidently chase bigger orders or even try out new international markets. It's estimated that trade finance supports something like more than 4/5 of all global trade. It's huge.
4/5.
Yeah. And it fosters better business relationships, too, building trust and reliability between buyers and sellers who might be worlds apart.
Okay, here's where it gets really interesting, though. Beyond these financial tools, there seems to be a pretty significant shift happening with global currencies, isn't there?
Yes, there is. Actually, an October 2023 paper from the EBRD highlighted this. They noted a, quote, reduced attractiveness of the U.S. dollar in international trade. And alongside that, a rise in alternative currencies being used for settling international trade. A really clear example is Russia increasingly using the Chinese yuan for invoicing its trade.
The yuan. So not just a minor tweak then.
No, not at all. It reflects broader geopolitical shifts, economic trends. Countries looking to diversify their risk, maybe move away slightly from relying so heavily on one historically dominant currency. And look, to understand how all this currency movement is tracked, it helps to briefly mention the balance of payments, the BBOP. It's essentially a country's financial scorecard with the rest of the world. All the economic transactions. It's broken down into different accounts: current, capital, financial. The current account, for instance, tracks trade in goods and services. Big imbalances there can signal economic issues and often drive these currency movements.
Okay.
And that naturally leads us to the foreign exchange market, or Forex. That's the global marketplace where currencies are traded. It determines the exchange rates, how many yen buy a dollar, how many euros buy a pound. And it makes sure the necessary currency exchange happens for all those BOP transactions.
Got it. So we covered the money side. The finance is crucial for managing risk. But actually moving the goods, that physical journey across borders, that introduces a whole different set of questions about who's responsible for what and when. How do you sort that out?
Yes. That's where Incoterms come in. Think of them as the rulebook for shipping responsibilities. They're published by the International Chamber of Commerce, the ICC, and they clearly define who pays for what, who handles the risk, and at what point responsibility transfers in global trade. They're a really key part of the sales contract. Their whole purpose is to simplify things and make sure everyone's on the same page.
The standardized rulebook makes sense.
Exactly. And the ICC keeps them updated. They've been doing it since 1936, I believe. The latest version is Incoterms 2020. That's the 9th revision. Just keeping the rules clear and relevant for how trade actually works today.
Okay, so how do these Incoterms practically work for an exporter or an importer? I mean, what kind of strategic choices are involved in picking one?
That's a great question. They're grouped, but maybe instead of listing all 11 terms, let's look at two common ones at opposite ends of the spectrum. It shows the range. So at one end, you have EXW. That stands for X works. This puts almost all the responsibility on the buyer. The seller just needs to make the goods available at their premises, like their factory or warehouse. From that point on, the buyer handles pretty much all the costs and risks: loading, shipping, insurance, customs, everything.
Okay. Minimal effort for the seller then.
Pretty much. Great for a seller, maybe without strong logistics, but it might limit who wants to buy from them. Then, at the completely other end, you have DDP, delivered, duty paid. Here, the seller takes on maximum responsibility. They handle everything to get the goods delivered to the buyer's specified location, cleared through customs, duties paid, ready for unloading. It's like a door-to-door service. Very attractive for buyers who want simplicity, but obviously involves more cost and risk for the seller.
Right, so it's a strategic choice based on logistics capability, risk appetite, maybe what your customer prefers.
Yeah, exactly. It boils down to control, risk, cost, and customer service.
And I heard the 2020 Incoterms update brought some important changes, reflecting how logistics have evolved.
It certainly did. For instance, they replaced an older term, DIT, delivered at terminal, with a new one called DPU, delivered at place unloaded. This just clarifies that the delivery point can be anywhere the parties agree on, not just a formal terminal. Could be a construction site, a warehouse, anywhere. More flexible. There were also key changes around insurance. Under CIF, which is common for sea freight, the seller only needs minimum insurance cover. But under CIP, often used for containerized or air freight, the 2020 rules now require comprehensive insurance cover by default.
Oh, that's a big difference.
It is. So for you, the listener, if you're importing something valuable, say electronics, using a CIP contract now gives you much better default insurance protection. The 2020 rules also added more detail on how costs are allocated between buyer and seller, tightened up security requirements, and interestingly, for the first time, explicitly allowed buyers or sellers to arrange transport using their own vehicles, not just hiring third-party carriers. Reflects the reality of modern logistics.
Right, people having their own trucks or transport arrangements.
Precisely. So the key takeaway, really, for anyone involved in trade is make sure your contracts are crystal clear about which Incoterms version you're using. You need to write, for example, CIF Long Beach Incoterms 2020 to avoid any disputes later.
Oh.
And just briefly on the practical process, generally the exporter handles their end export customs declarations, ensuring the goods comply. Then, once the goods arrive, the importer takes over for customs clearance. That means providing documents like the bill of lading, the commercial invoice, paying duties and taxes, and making sure everything meets local import rules.
Okay, so as those goods are moving, crossing borders, there's this really vital player, often sort of in the background, but always there: customs. They really are the gatekeepers, aren't they?
Absolutely. Customs administrations are essentially the doorkeepers of international trade. Their main jobs are collecting tariffs, those import taxes, and controlling what goods come into and go out of a country. And a really important concept linked to their work is trade facilitation. This basically means any action aimed at simplifying and harmonizing international trade procedures, making things smoother. In practice, it's about boosting trade by cutting down on bureaucratic red tape, reducing those expensive delays for businesses, and lowering the administrative costs at the border.
And the impact of getting that right, the efficiency of customs and trade facilitation, it's huge. I saw some stats like every single day of delay in shipping adds about, what, 0.8% to the cost of manufactured goods?
That's right, it adds up incredibly quickly.
And the OECD figured that just a 1% saving in transaction costs globally could mean a benefit of something like 43 billion US dollars worldwide.
Staggering numbers. And that's why things like the WTO's Trade Facilitation Agreement, the TFA, which came into force in 2017, are so important. The aim there is to cut global trade costs by an average of over 14%. The potential export gains are estimated in the hundreds of billions, maybe even up to $1 trillion a year.
Wow. So how do customs administrations actually manage all this? What are their different roles?
Well, they really wear several hats. There's the fiscal role, collecting revenue, the duties and taxes that governments rely on. Then there's the economic role, implementing government policies, things like import quotas or enforcing trade agreements. And crucially, there's the protection and security role. This is about protecting citizens' health, safety, and the environment. It means stopping illegal trade things like drugs, weapons, counterfeit goods, smuggled items.
Right. And that highlights this constant tension, doesn't it? Customs has to try and strike a balance between these sometimes conflicting goals. On one hand, they need to facilitate trade, keep things moving quickly so businesses don't face costly delays. But on the other hand, they have to enforce controls rigorously to protect the public, the economy, national security. It must be a really delicate balancing act.
It absolutely is a constant challenge. Finding that sweet spot between speed and control is the daily grind for customs officials worldwide, and it affects every single item that crosses a border.
Okay, so we've talked about the systems, the finance, the rules, the gatekeepers. But despite all this sophistication, there's a significant challenge, often unseen, that can really undermine it all. And that's corruption.
Yes, unfortunately, corruption, particularly in customs, is a serious and widespread issue. In some places, especially maybe in transitional economies, it's been described as almost an established norm within customs organizations. It adds a huge amount of friction.
And what's fascinating here, although maybe a bit disturbing, is this controversial idea called the grease the wheels hypothesis. Can you explain that? And more importantly, why the research seems to show it's, well, flawed thinking.
Right, the grease the wheels hypothesis. The basic idea is that in systems where you have really complex regulations and maybe weak institutions, paying a bribe might seem like a shortcut. It might look like it helps companies get around bureaucratic hurdles faster, almost like a perverse form of deregulation. You pay to speed things up or bypass a rule.
So it seems efficient on the surface, maybe.
Maybe if you only look very narrowly and short term. But, and this is the crucial counterbalance, the overwhelming empirical research finds that corruption has a negative effect on international trade overall. It actually increases the cost of exporting, it makes contracts less reliable, it essentially acts like an unpredictable hidden tariff. So while one person might get their goods through faster once by paying a bribe, the overall system becomes less efficient, less predictable, and ultimately harms trade. It doesn't grease the wheels for the economy as a whole.
Okay, that makes sense. It undermines the whole system's integrity.
Exactly. And we can even break down customs corruption into different types. First, there's what you might call routine corruption. This is where officials might deliberately delay or complicate standard procedures until a bribe is offered just to get normal or maybe slightly faster service. An example sometimes cited is, say, officials only agreeing to work past official hours if they receive informal payments.
Paying for what should be standard service.
Pretty much. Then there's fraudulent corruption. This is often initiated by the traders themselves or operators. They bribe officials to basically look the other way, maybe to ignore procedural requirements, often to lower their tax bill by, say, misdeclaring the type of goods, misclassifying them, or undervaluing them.
Deliberately cheating the system with help from the inside.
Yes. And finally, there's criminal corruption. This is the most serious kind, where organized crime groups bribe officials to allow the smuggling of illegal goods, drugs, weapons, trafficked items, huge security implications there.
Understanding those different types, routine, fraudulent, criminal, It really shows another layer of complexity and risk in this whole global trade picture. It's a constant battle against these hidden costs and vulnerabilities.
It really is.
Well, we've covered a lot of ground today. We've taken quite a journey through this intricate world of global trade, from just the sheer scale of it all to the complex financial mechanics that keep it oiled, the rules like Incoterms that try to bring order, the vital role of customs as gatekeepers, and even that difficult shadow of corruption.
Yeah, I think what really comes through is that international trade isn't just about boxes on ships. It's this incredibly dynamic, constantly evolving system. It's always trying to balance that need for speed and efficiency with the absolute necessity of security and compliance. It's a human system, ultimately, with all the challenges and ingenuity that implies.
So here's a final thought for you, our listener. Next time you pick up a product, maybe something imported from halfway around the world, just take a moment. Consider all those unseen layers, the finance, the rules, the logistics, the human interactions, both the efficient ones and the challenging ones that had to align perfectly to bring that item right into your hands. What part of that whole complex journey do you think will change the most in the next 5 years? And how might those changes affect what eventually ends up with you?